marginal and absorption costing. Marginal and absorption costing. Marginal costing is a costing technique where fixed overheads are treated as the cost of the period and are written off in the period to which they relate. The costing technique in which the fixed overheads are treated as the cost of the period and are written off in the period to which they relate. That is marginal costing. In other words, marginal costing distinguishes the fixed cost and the variable cost. It distinguishes the fixed and the variable cost. That is marginal costing. Marginal cost is an additional cost incurred in production of one extra unit. Marginal cost is an additional cost incurred in production of one extra unit. Marginal costs are the variable cost. Variable cost, that is marginal cost. Variable cost will include the direct materials, direct labor, variable production overheads, variable selling and administrative overheads. Marginal costs are the variable costs. Absorption costing. Absorption costing. Absorption costing is a total costing technique. Total. By total cost will mean the fixed cost plus variable cost. The total costing technique in which the fixed production overheads, I didn't say all the fixed overheads, only the fixed production overheads, in which the fixed production overheads form part of the cost of the product. The fixed production overheads form part of the cost of the product. But if you look at the marginal costing, when I was defining it, fixed production overheads will be treated as the cost of the period, and it will be written off in that period. That is in the case of marginal costing. Fixed production overhead does not form part of the cost of the product in the case of marginal costing. But in terms of absorption costing, the fixed production overheads will form part of the cost of the product. That is for absorption costing. Differences between marginal costing and absorption costing. Marginal costing and absorption costing. Absorption costing. So marginal costing is used for decision making purpose. Marginal costing is used for the purpose of the decision making. While absorption costing is for routine purpose. For routine purpose. Absorption costing is for routine purpose. In terms of marginal costing, contribution form part of the operating statement. Contribution form part of the operating statement. The key concept or key issue in marginal costing is contribution. But absorption costing, no contribution is involved. Contribution doesn't form part of the operating statement in terms of absorption costing. In marginal costing, there is nothing like under or over absorption. No under or over absorption, no under or over absorption of fixed production overheads. I use the word fixed production, not all the overheads. It is the production alone that will be absorbed. Here, no under, you don't have under. There is nothing like under or over absorption in marginal costing. But in terms of absorption costing, under or over absorption of fixed production overheads form part of the operating statement. You must have an under or over absorption of fixed production overheads in terms of absorption costing. Under marginal costing, inventory are valued. Inventory are valued at the variable production cost per unit. Meaning that in valuation of your inventory, only the variable production cost that will be considered. It's only the variable production cost that will be considered. You don't consider the variable selling and admin. You don't consider the distribution cost. You value your inventory at the variable production cost per unit under marginal costing. But under absorption costing, inventory are valued at the total production cost per unit. You use the total production cost per unit in valuing your inventory. By total production cost, it means you will consider both the variable production cost and fixed production cost in valuing your inventory under absorption costing. I've told you that the key or the major concept, we use marginal costing for purpose of decision, but we use absorption for routine. There used to be contribution in our operating statement under marginal costing, but no contribution in absorption costing. We don't used to have under or over absorption in marginal, but we used to have that in absorption costing. We value inventory at the variable production cost per unit. Only variable production cost will be considered in marginal costing. In absorption costing, you consider the total, that is both fixed and variable production cost. It's only production cost you consider when you are valuing your inventory. Now when you have total cost, your total cost can be divided into two: production cost and non-production cost. Production cost and non-production cost. Your production cost can be divided into two: the direct cost and indirect cost. Direct costs are prime costs. Prime costs are the direct costs. Prime cost is the aggregate of the direct materials, direct labor, and direct expenses. The aggregate, the total of direct materials, direct labor, and direct expenses, that is prime cost. So, direct costs are prime costs. So, all these costs are variable costs. Indirect costs are what we call overheads. Overheads. You can have factory rent and rate, factory power, factory lighting and heating, factory salary. All those costs that are not direct, we regard them as overheads. Overheads are indirect costs. Overheads are the aggregates of indirect materials, indirect labor, and indirect expenses. Non-production costs. Those costs that doesn't relate to production. You can have administrative costs. Administrative costs. Costs incurred for the purpose of administration. Your salaries and wages, your rent and rates, your transportation expenses, insurance, and so on. It doesn't relate to production. Then, we also have selling and distribution expenses. These expenses are incurred purposely for sales. You can have advertising expenses, you can have carriage outwards. All those expenses that relate to selling and distribution will be categorized under this. These expenses doesn't relate to sales. When you aggregate the production cost and the non-production cost, it will give us what is called the total cost. Some of these two will give us the total cost. So, now, I've told you that I've given you the difference between marginal and absorption costing. So, I've told you that the key concept in marginal costing is contribution. What do we mean by contribution? Contribution is the excess of sales over variable costs. Excess of sales over marginal cost of sales. Excess of sales over variable cost. That is contribution. I told you earlier that the variable costs, the marginal costs are the variable costs. So excess of sales over variable cost. That is contribution. That is sales minus variable cost. Sales minus variable cost. That is contribution. Now, we want to prepare the operating statement. XYZ Limited. Operating statement. Using marginal costing approach. Operating statement. Using marginal costing. You have sales. From sales, you less variable cost or less marginal cost. You have opening inventory, opening stocks. I told you earlier that you value it at variable production cost per unit under marginal costing. When I was giving you the difference between marginal and absorption costing, I said inventory are valued at the variable production cost per unit. Variable production cost per unit. So meaning that you value this inventory, value the variable production cost per unit. That is, you are setting your production cost and you use it to multiply your inventory. Then you also have direct materials. This is also a variable cost. Direct labor, you have variable production overheads. All these costs I've considered, they are all variable. When you aggregate this, you less closing inventory. Don't forget, you value your inventory, value the variable production cost per unit. So same value. You value your inventory at variable production cost per unit. When you less that, you get factory contribution. Factory contribution. I call it factory because the variable cost you have considered alone are those ones that relate to production. So you have factory contribution. Now less variable non-production cost. Variable selling and distribution. Variable admin expenses, variable admin expenses. When you less all the variable costs, you get total contribution. You get total contribution. You now less. I've told you that your fixed cost will be treated as the cost of the period. So it is at this juncture that you less all your fixed costs, less fixed cost. Your fixed cost, you can have fixed production, overheads, fixed administrative overheads, fixed selling and distribution overheads. You less all your fixed costs. When you less your fixed costs, you arrive at the net profit. Net profit. That is marginal costing. Operating statement. Marginal costing. Marginal costing. You first of all consider your variable costs, variable production costs, in order to get the factory contribution. You less variable non-production costs to get your total contribution. You now less all your fixed costs. That will give us the marginal costing operating statement. Then the next one is absorption. Absorption costing. I've told you that there is nothing like contribution. In the case of absorption costing, no contribution. No contribution at all. No contribution. But I've told you that there will be an under or over absorption. I've told you earlier that overheads are indirect costs. Under absorption of fixed production overheads. My emphasis, the one you want to absorb is the production one. Not all the fixed overheads that will be absorbed. You are going to treat non-production, the fixed one. You are going to treat them separately. My concern is the one that relates to production. Under absorbed, under means below. When the overheads absorbed is less than the actual amount of overheads incurred, that is under absorption. Under absorption, it means the overheads you charge to the product is less than the actual amount of overheads incurred. That is under absorption. The overheads absorbed is less than the actual. The one absorbed is less than the actual. That is under absorption. Why over absorption is when the overheads absorbed is greater than the actual overheads incurred. Overheads absorbed, overheads chargeable to the product, overheads you charge to the product is greater than the actual amount of overheads incurred. That is over absorption. How do you get the overheads absorbed? Overheads absorbed. To calculate the overheads absorbed, you will have determined your overheads absorption rate. You have the overheads absorption rate multiplied by the actual production. Actual production units. This will give you the overheads absorbed. Overhead absorption rate multiplied by the actual production units. Productive output. So that will give you the overhead absorbed. You now compare this with the actual overheads incurred. I have told you to compute the overhead absorption rate. It is the budgeted data you are going to use. The normal capacity. The budgeted data will be used in computing the overhead absorption rate. Not the actual data of the period. It is the budgeted, the one based on the budget. Sometimes it might appear as the normal capacity. Sometimes it will appear as budgeted expenditure or whatever. Sometimes they might call it normal. So it is the budget that will be used. Your overhead absorption rate is equal to the budgeted overheads over budgeted level of activity. Budgeted level of activity. That will give you the overhead absorption rate. Budgeted overheads over budgeted level of activity. That will give you the overhead absorption rate. By overhead absorption rate, we mean the rate at which the overheads will be charged to the product, or the rate at which overheads are chargeable to the products. Overhead absorption rate is the rate at which overheads are chargeable to the product. The rate at which you can use to charge your overheads to the product. The rate at which overheads will be recovered. That is the overhead recovery rate. Now, your level of activity could be anything. It could be direct labor. It could be machine hour. It could be labor hour. It could be output. So where it is labor hourly rate. Labor hourly rate. Your overhead absorption rate will now become budgeted overheads over budgeted direct labor hour. For machine hourly rate, machine hourly rate. So where it is used as the basis, your overhead absorption rate will be budgeted overheads over budgeted machine hour. When you watch my comprehensive lecture on overheads, you'll be able to have the comprehensive and work examples on this. So please try to subscribe to keep up with my upcoming video lectures. So to continue to receive notification as I'll be dropping the videos from time to time. So, as a percentage of direct materials, your overhead absorption rate will be budgeted overheads over budgeted direct materials. Times 100. If it is as a percentage of direct labor, then you have overhead absorption rate to be budgeted overheads over budgeted direct labor. If it is productive output, overhead absorption rate will be budgeted overhead over budgeted output. So depend on the basis you are to use in recovering it. That is for that. So we want to take a work example. Oh, before I take a work example, let me give you the format for preparing the operating statement under absorption costing. So, now, this is for absorption. So, with less closing inventory. Valued at total production costs per unit. You value your closing inventory at the total production cost per unit. By total production cost per unit, it means you are going to consider both variable and the fixed production cost. When you less that, now add, if If it is under absorption, you add it. Add or less. Under or over absorption. Absorption of fixed production overhead. If it is under absorption, you add. If it is over absorption, you less. You add under absorption of fixed production overhead, you less over absorption. By over, it means the one that have been charged. The one you charge here, the one absorbed here, is greater than the actual. So you now deduct the over absorption. But if it is under absorption, the one you charge here is less than the actual fixed production overhead. So in that case, you add the under absorption here. So then you now get your cost of sales. Your cost of sales, when you less that, you get gross profit. Then after gross profit, you now less non-production cost. Less non-production cost. Your non-production cost, those one that doesn't relate production, you can have variable, selling, and distribution expenses. You can have fixed, selling, and distribution expenses. You can have variable admin expenses, administrative expenses. Then you can as well have fixed administrative expenses. Remember, the fixed production costs have been considered here. So it is those costs that doesn't relate to production you consider here. Both variable and the fixed. Those one that doesn't relate to production, you consider them here. You less that from the gross profit above, you arrive at the net profit. The net profit. The net profit. I want to take work examples, and the questions I'm about to solve now will be obtained from F5, ACCA F5 by BPP Learning Media. ACCA F5 by BPP Learning Media, or BPP International. The production department has a budgeted production overhead of $180,000 and budgeted activity of $45,000. This is the budgeted overhead, $180,000, and the budgeted activity is 45,000 machine hours. Overheads are absorbed on a machine hourly basis. That is the basis of absorption. Require you to calculate the under or over absorbed overheads and note the reasons for the under or over absorption in the following circumstances. So the first thing, you compute the overhead absorption rate. We said overhead absorption rate equals to the budgeted overheads over budgeted level of activity. But the activity here is the machine hour machine hour basis. Since machine hourly rate is used. So the denominator will be budgeted machine hours. Budgeted overheads is 180,000. 180,000. Budgeted machine hours is 45,000. So 180,000 divided by 45,000, that will give us $4 overhead absorption rate. It will be $4 per machine hour. Now, calculate the under or over absorbed overheads and note the reasons for the under or over absorption in the following circumstances. A. You want to calculate the under or over absorbed overheads. Overheads absorbed now. Overheads absorbed. The overhead absorption rate as calculated is $4 multiplied by the activity, which is 45,000 machine hours. So, times 45,000. So we have 4 times 45,000, and that will give us $180,000. Overheads absorbed is $180,000. The actual overheads cost is $170,000. Actual overheads, $170,000. So the one absorbed is greater than the actual. There is a difference of 10,000. Because the absorbed is more than actual, that is to show that there is over absorption. Over absorption of the fixed production overhead. What are the probable reasons for this over absorption of fixed production overhead? The budgeted activity is 45,000, and the actual is 45,000. The actual activity is the same as budget, but the actual overhead is less than the budgeted overhead. So that is the reason for the over absorption of the overhead. B. You are given actual overheads of 180,000. Overheads absorbed. Overheads absorbed. 180,000. That is 4 times. Sorry, it's not 180,000. Overheads absorbed. It will be 4 times the actual capacity, 40,000. 4 times 40,000, that will give us 160,000. Actual overheads. The actual overheads is 180,000. The overheads absorbed is less than the actual. There is 20,000 difference, which is under absorption of the overheads. Under absorption. The reason for this under absorption is because the actual activity, the budgeted activity is greater than the actual activity. So that is just the reason for the under absorption. It is under because the one absorbed is less than the actual. RH makes and sells one product which has the following standard production cost. Direct labor, 3 hours at $6 per hour. Direct materials, 4 kg at $7 per kg. Variable production overhead, $3. Fixed production overhead, $20. Standard production cost per unit is $69. Normal output is 16,000 units per annum. Variable selling, distribution, and administration costs are 20% of sales value. Fixed selling, distribution, and administration costs are $180,000 per annum. There are no units in finished goods inventory at 1st of October 2022. The following the fixed overhead expenditure is spread evenly throughout the year. The selling price per unit is $140. Production and sales budgets are as follows. 6 months ending 31st March 2023 and 6 months ending 30th of September 2023. You are given production to be 8,500 and 7,000 respectively. Sales 7,000 and 8,000 required. Prepare profit statement for each of the 6 months periods using the following methods of costing. A. Marginal costing. B. Absorption costing. So that is the question. So solution. For our purpose, so let's try to determine the value of the opening and closing inventories. Why will you need to determine that? The production and sales are not the same. Since it's not all the units produced that are sold, that means you may likely have the closing inventory. You need to determine the closing inventory because your production is not the same as sales. For this period now, the closing inventory will be 1,500. Since you produced or you have produced 8,500 and out of which 7,000 units were sold, that means you'll be left with 1,500 in the inventory. So now let's look at the movement in inventory. Movement in inventory. The first period is 31st of March 20x3, the period ending, and the second one is 30th of September 20x3. Those are the periods. Then, in your movement in inventory, you start with the closing inventory. You start with, the opening inventory. You start with the opening inventory. You have opening inventory. Opening inventory. For the first period, your production was 8,500. And you were told that there are no units in finished goods inventory at 1st of October as 2022. That means there are no opening inventory. So opening inventory for that period will be dash. Then you have production. Production. The unit produced in the first 6 months is 8,500. Production, when you add the production to opening inventory, then you'll be having 8,500 units in stock. Now less units sold. Units sold. Opening, your production is in units. Your opening inventory too must be in unit. So units sold. In the first period, 7,000 units were sold. If 7,000 units were sold, and you subtract 7,000 from 8,500, you'll be left with the closing inventory. Closing inventory of 1,500. 1,500. Since the closing inventory in the first period ending 31st March 20x3 is 1,500, the closing inventory for this period will be the opening inventory of the next period. That means the opening inventory will be 1,500. In the second period ending 30th of September 2023, the number of units produced is 7,000 units. And the units sold is 8,000. So 7,000 units were produced. Then if you add it to the opening inventory, that means you'll be having 8,500 units in stock. And the number of units sold during this period ending 30th of September 2023 is 8,000 units. So when you subtract that 8,000, then you'll be having the closing inventory of 500 units. That is the closing inventory. Now, you are to prepare the profit statement using marginal costing. Now, the name of the entity is RH. RH. So you can have RH. Profit statement for the period ending. So there are two periods. We have 31st March. The first period is 31st March 20x3, while the latter period is 30th of September 20x3. So you want to use marginal costing principle. Let's put dollar sign. You want to use marginal costing. Let me put marginal costing here. Marginal costing approach. So in marginal costing, I've given you the format for preparing the profit statement. The first thing should be sales or revenue. Your sales. The number of units sold in the first period is 7,000 units. 7,000 units multiplied by the selling price. And the selling price per unit for that period, for each of the period, the selling price per unit is $140. $140. So 7,000 times 140. And that will give us the total sales revenue. 7,000 times 140. And that will give us 980,000. From that, you less variable cost. Know your focus is on the determination of the contribution. And I've told you that contribution is sales less the variable cost. Now, this is your sales. So you less your variable cost. Your variable cost, the first thing should be the opening inventory. Opening inventory. I've told you that your inventory under marginal cost will be valued at the variable production cost of sales. Those variable costs that relate to production. You don't consider the non-production. You only consider the production, and you must use variable cost only. So there are no opening inventory in the first period, so you put dash. Other costs you have include direct labor, and which is $18. Direct labor of $18. So you have direct labor, $18 times the number of units produced. You use production. If your inventory is included, you must use the production. But if you are eliminating inventory, it is then that you can use sales directly. So since I'm including inventory in the format, so I'm going to use the unit produced, 8,500. So we have 18 times 8,500, and that will give us $153,000. That is direct labor. The next one is direct materials of $28. Direct materials. Direct materials of $28. 28 times the unit produced, which is 8,500. 28 times 8,500. 28 times 8,500. And that will give us 238,000. The next one is variable production overhead of $3. Variable production overhead of $3, 3 times the unit produced of 8,500. 8,500 times 3. That is 25,500. Now, no other variable cost here. No, it is variable cost you want to less. This is fixed cost. So you don't, fixed cost will be treated as the cost of the period. So when you sum up this, you have 153,000 plus 238,000 plus 25,500. This will give us 416,500. Then from that, you less your closing inventory. Less closing inventory. I've told you that your inventory under marginal costing principle will be valued at the variable production cost. The closing inventory in units is 1,500. Here, you have 1,500 times your variable production cost per unit. you go back to your costs. Those ones that are variable are these three elements. Your variable production cost, the variable production cost. Though we still have one variable cost here, variable selling, distribution, and admin. These variable costs will not be considered in the inventory valuation because they doesn't relate to production. I told you that the variable cost that will be considered will be the variable production cost. So you sum it up, 18 plus 28 plus 3, and that will give us $49. The sum of this is $49. It is that $49 that you use to value your inventory. That is 1,500 times 49, and that will give us 73,500. 73,500. You less your inventory. Now, when you subtract 73,500 from 416,500. 416,500. You'll be left with 343,000. 343,000. That 343,000 represents the total variable production cost. When you less the variable production cost from sales of 980,000, then you will have the factory contribution. Factory contribution. Factory contribution. So when you less that from 980,000, so your factory contribution is 637,000. 637,000. After that, you now less other variable cost. Less the other variable costs we have include variable selling, distribution, and administration costs, which are 20% of sales value. You have been told your variable selling, distribution, and admin is 20% of sales value. So we now less variable selling, distribution, and administration, which is 20% of sales value. 20% of sales value. And our sales value is 980,000. 980,000. So 20% of 980,000. 980,000. 20% of that will give us 196,000. 196,000. If you less that 196,000 from 637,000, then you will have 441,000. That 441,000 represents the total contribution. Total contribution. Now, after that, you cannot less your fixed costs. You should notice that all the costs we have considered so far are those that are purely variable. We've not considered any of the fixed costs. So now, I've told you that in marginal costing, fixed costs should be treated as the cost of the period, and they should be written off in the period to which they relate. So now, less fixed cost. Fixed cost. Our fixed cost, we have fixed production overheads, which is $20 per unit. And that will be absorbed based on the budgeted production. Your normal output is 16,000 units. So it is that budgeted, normal capacity or normal output, that is budgeted. It is that you should use to value your fixed cost. So $20, since it is a standard cost, $20 times 16,000. That is fixed cost per annum. That will give us the fixed cost per annum. But you have been told that the fixed overhead expenditure is spread evenly throughout the year. Since it is spread evenly throughout the year, you have fixed production overheads. Production overheads. $20 times that 16,000. That will give you the fixed production overheads for the year. 20 times 16,000. And the fixed production overheads for the year will be 320,000. But remember, this operating statement is prepared for 6 months ending. Therefore, it is the fixed cost that relates to 6 months that will be considered. So in that case, you have times 6 months out of 12 months in a year, and that will give us, it will give us 160,000. You also check if you have other fixed costs. Fixed selling, distribution, and administration costs are 180,000 per annum. So this 180,000 is also for a year. So as you are preparing your profit statement for 6 months, so you need to calculate that of the 6 months. So we have fixed selling, distribution, and administration of 180,000 per annum for 6 months now will be 90,000. So if you less the 160,000 and 90,000, if you deduct the sum of the two from 441,000, then you'll be having 191,000. That 191,000 is the net profit. Net profit for the 6 months ending. Net profit for the 6 months ending 31st March 20x3. Then you also want to prepare the profit statement for the 6 months ending 30th September 20x3. 6 months ending 30th September 20x3. So you also start with sales. The sales for the period or for the 6 months ending 30th September is 8,000. 8,000. And the selling price per unit is 140. So you can have 140 times 8,000. So you will have 140 times 8,000, and that will give us 1,120,000. Then from that you less variable cost. You less variable costs. Our variable costs include, you start with opening inventory, opening inventory, opening inventory. For the 6 months ending 30th of September 20x3, opening inventory is 1,500 units. 1,500. I've told you that your inventory should be valued at the variable production cost. 1,500 multiplied by the variable production cost per unit. And that is $49. $49. We have 1,500 times 49. 15 times 49. And that will give us 73,500. 73,500. Then you consider other variable costs, which include direct labor, $18. Direct labor of $18 per unit. $18 per unit multiplied by the units produced. The units produced in the second period is 7,000, which is this 7,000 here. So 7,000, 18 times 7,000, and that will give us 126,000. Then we also have direct materials, which is $28. Direct materials of $28 multiplied by the unit produced. The unit produced is 7,000 units. So we have 28 times 7,000, and that will give us 196,000. 196,000. Then you check. Then you also have variable production overheads of $3. variable production overheads of $3. This question is obtained from BPP study text, F5, BPP, ACCA. So please subscribe to this YouTube channel to keep up with the the video lectures, as it will be dropping on this channel from time to time. So variable production overheads. Variable production overheads of $3 times unit produced, which is 7,000. You have 3 times 7,000, and that will give us 21,000. When you sum it up, so since you have 196,000 plus 126,000 plus 73,500, and that will give us 416,500. From that, you less closing inventory. Less closing inventory. I've told you that your inventory should be valued at the variable production cost of sales. Your closing inventory in this period is 500 units. 500 units multiplied by the variable production cost. Variable production cost of sales, and that is $49. So we have 500 times 49. 500 times 49, and that will give us 24,500. 24,500. So if you less that from 416,500, if you subtract it from 416,500, then you'll be left with 392,000. 392,000. Then you subtract 392,000 from sales of 1,120,000, and then you have factory contribution. Factory contribution of 728,000. Factory contribution of 728,000. So then from the factory contribution, you less other variable costs. You less other variable costs. Then we have variable selling, distribution, and administration cost, which is given to be 20% of sales value. So you less variable selling, distribution, and admin. And you were told that it's 20%. You were told that it is 20% of sales value. And our sales value is 1,120,000. 20% of 1,120,000. So calculate 20% of that. 1,120,000. And that will give us 224,000. If you subtract 224,000 from the factory contribution of 728,000, then you will have 504,000. 504,000. That is the total contribution. Total contribution. From the total contribution of 504,000, now less fixed cost. Don't forget, I've told you that fixed cost should be treated as the cost of the period in marginal costing. Fixed cost should be treated as the cost of the period. And our fixed cost, we have fixed production overheads, which is $20. Fixed production overheads. Fixed production overheads, $20. I've told you that you multiply it by the budgeted production or projected output of 16,000. So, sorry, $20 times 16,000. And since your profit statement is for 6 months, so you will need to calculate, you apply time apportionment, calculate for that of the 6 months. 20 times 16,000 times 6/12. And that will give us 160,000. Then you also have the fees, selling, distribution, and administration costs, which is 180,000 per annum. So you need that of 6 months. Fees, selling, distribution, and admin. 180,000 times 6/12. And that will give us 90,000. If you sum it up, if you sum it up, it will be 250,000. 250,000. If you subtract 250,000 from the contribution of 504,000, then you have the net profit of 254,000. The net profit of 254,000. That is the profit statement under marginal costing. So, profit statement in line with absorption costing. RH, our profit statement for the period ending. So, you want to prepare for 31st March 20x for the 6 months ending, for the 6 months ending. So 31st March 20x3. So you start with sales. Your sales, the number of units sold in the first period is 7,000. Multiplied by the selling price of 140. And that will give us 7,000 times 140. We have 980,000. 980,000. Since it is absorption costing, you now less cost of sales, less cost of sales. You are using absorption costing. Absorption costing method. So less cost of sales, not variable cost this time around. Let me put production cost of sales. It is production cost of sales less production cost of sales. By production cost of sales, it means those costs that should be considered this time around should be those ones that relate to production. Any cost that doesn't relate to production should not be considered. It's only the production cost that should be considered. So you start with opening inventory. Opening inventory. Your opening inventory, there are no opening inventory in the first period. Opening inventory is nil. Then you have direct labor. Direct labor. Direct labor, we have $18. Direct labor, $18 times units produced, which is 8,500. 18 times 8,500, and that will give us 153,000. Then we also have the direct materials of $28. Direct materials. 28 times 8,500. 8,500 times 28. That will give us 238,000. Then we also have variable production overheads, which is 3. Variable production overheads. 3 times 8,500. 3 times 8,500. And that will give us 25,500. I have told you that under absorption costing, fixed production cost will be considered too. That is why I said you value your inventory as the total production cost of sales per unit. Production cost of sales per unit. Your fixed production overheads is $20. So if you look at the format I gave you, I said fixed production overheads absorbed. It is the one absorbed you need here. The fixed production overheads absorbed. And I've told you that to absorb overheads, you multiply your overhead absorption rate by the actual production. The overhead absorption, fixed production overhead absorption rate is $20, and the actual production is 8,500. So you have 20 times 8,500. 20 times 8,500. That gives us 170,000. That is the fixed production overheads absorbed. Then when you add this, so plus 25,500 plus 238,000 plus 153,000, then you have 586,500. So with less closing inventories, less closing inventories. Our closing inventory is 1,500 units. Don't forget, I've told you that under absorption costing technique, your inventory will be valued at the production cost of sales. By production cost of sales, that means you will consider both the fixed and variable production costs. Where the fixed production overhead absorption rate is not given here, you will need to determine that by dividing the budgeted overheads by the budgeted level of activity. When you do that, you add it to the variable in order to get this figure. But this one has been given directly in this question. So you take that 69. 69. So we have 1,500 times 69. And that will give us 103,500. 103,500. Now you subtract it from 586,500. 586,500. And you have 4. Then when you subtract it, you will have 483,000. 483,000. Then at this juncture, you consider your under or over absorption. Under or over absorption. Now, the overheads, the fixed overheads absorbed, the one absorbed is 170,000 here. Then how much is the actual fixed overheads for the period? The absorbed is 170,000. The actual will be the actual fixed overheads. Fixed production overheads. 20 times 16,000, which is 320,000. That is for a year. Then for 6 months now, 320,000 divided by 12 times 6. And that will give us 160,000. The actual fixed overheads is 160,000. The one absorbed is 170,000. Since the one absorbed is more than the actual, then that means there is over absorption. Over absorption, which is 170,000 minus 160,000. Then you have 10,000. I've told you that the amount of over-absorption should be subtracted. When you subtract 10,000 from 483,000, then you have 473,000. That is our cost of sales. Then you now subtract your cost of sales from the sales of 980,000. Then when you subtract it from 980,000, then you have the gross profit of 507,000. That is gross profit. Our gross profit is 507,000. 507,000. Your under absorption, the over absorption, this is how I got that. Over absorption. Absorption of fixed overheads. This is how I got that. The overheads absorbed. Absorbed. Which is overhead absorption rate of 20. Overhead absorption rate of 20 times 8,500. 20 times 8,500. And that gave me 170,000. Then the actual fixed overheads. Actual, which is 20 times the budgeted units or output of 16,000. 20 times 16,000 times 6 months out of 12 months. Since you are preparing the profit statement for 6 months ending, and that gives us 160,000. So since the one absorbed is greater than the actual, then you have over absorption of 10,000. That is how I got this 10,000. This is our gross profit. Then after gross profit, you less non-production cost. We have considered all the costs or expenses that relate to production. We now want to consider those ones that doesn't relate to production. The non-production costs, we have variable selling, distribution, and administration, which is 20% of sales. So we have variable selling, distribution, and administration. And you were told that that is 20% of sales. 20% of sales. And our sales is 980,000. Sales is 980,000. 20% of 980,000. And that will give us 196,000. Yes, you also have fixed selling, distribution, and administration. And that is 180,000 per annum. Fixed selling, distribution, and administration. And which is 180,000 per annum. Since your financial statement, your profit statement is for 6 months, so you calculate that of 6 months, and that will give us 90,000. If you subtract the 196,000 and 90,000 from 507,000, then you have 221,000, and that is our net profit for that period, for the 6 months ending 31st March 20x3. Then you equally want to prepare the profit statement for the second 6 months. That is the one ending 30th of September 20x3. The profit statement for the 6 months ending 30th September 20x3 Then the first issue will be sales. The number of units sold in the second period is 8,000. And that is the 8,000 we have here. 8,000, yeah. 8,000 multiplied by the selling price per unit of 140. 8,000 times 140. And that will give us 1,120,000. From sales, we are using the absorption costing. So you less production costs of sales. And you start with your opening inventories. Opening inventory. The opening inventory for this period is 1,500 units, which I have rubbed off. 1,500 times, you value it at the total production cost of sales. I've told you that this time around your fixed cost will be considered. Then you have 69. It is under marginal that you don't consider the fixed cost. Times 69, 1,500 times 69. And that will give us 103,500. Then you have direct labor of $18. Direct labor, $18 per unit. 18 times the number of units produced. The number of units produced in the second 6 months ending is 7,000 units. So 18 times 7,000. 18 times 7,000. And that will give us 126,000. 126,000. Then we also have the direct materials, $28. Direct materials, $28 multiplied by units produced of 7,000. 28 times 7,000. And that will give us 196,000. That is for direct materials. Then we also have the variable production overheads. Variable production overheads, which is $3. Variable production overheads, $3 times units produced, which is 7,000. There you have 21,000. Then I've told you that it is the production cost of sales unit. That means the fixed production cost, fixed production overheads will be considered too. So you have fixed, but I've told you that you are going to absorb it here. You have fixed production overheads absorbed. Fixed production overheads absorbed. Our fixed production overheads absorption rate is $20. I've told you that to absorb your overheads, you multiply by the actual production, which is 7,000 for the second period. 20 times 7,000. And that will give us 140,000. 140,000. Now, the production cost of sales have been considered. Then you sum it up. Plus 21,000 plus 196,000 plus 126,000 plus 103,500. The total of that is 586,500. 586,500. Then you less your closing inventory. Less closing inventories. The number of units in the closing inventory for the second 6 months ending is 500 units. You have 500 times. I've told you that you value your inventory. You should value your inventory at the total or the production cost of sales. That is, both fees and variable costs will be considered. So you have 69. 500 times 69. 500 times 69, you have 34,500. So when you less that, from 586,500 minus 586,500, then you have 552,000. 552,000. So, after this, you consider the amount of under and over absorption. I've told you that it is under where the fixed overheads absorbed is greater than the actual fixed overheads incurred. So now, the one absorbed, fixed production overheads absorbed, is $140,000. The actual, now, we want to calculate fixed production overheads absorbed, which is overhead absorption rate 20 times the actual production of 7,000. I will have 140,000. The actual fixed production overheads for that 6 months ending, actual, since you have the rate 20 times 16,000. 20 times 16,000. 20 times 16,000. Then for 6 months, that will be 160,000. The one absorbed is less than the actual. That means we have under absorption. Under absorption of $20,000. I've told you that when you have under absorption, you are going to add that. So we add under absorption, which is $20,000. When you add the $20,000 to the $552,000 we have here, then you have total of $572,000. The $572,000, that is our cost of sales. When you subtract your cost of sales, production cost of sales, from your sales of 1,120,000, then you have the gross profit. Gross profit of 548,000. 548,000. After gross profit, you less non-production costs. Non-production costs. Our non-production costs, those costs that doesn't relate to production, we have the variable and fixed. So we have variable, selling, distribution, and admin. And you were told that that variable is 20% of sales. So we have 20% of sales. Our sale for the second 6 months ending is $1,120,000. 20% of 1,120,000. And that will give us 20% of 1,120,000. 1,120,000. And that will give us 224,000. Other non-production costs we have include fees, selling, distribution, and administration costs, and which is 180,000. Fees, selling, distribution, and administration costs. And we're told it's 180,000 per annum. So for 6 months now, will be 90,000. So the 90,000, where you add it to 224,000, then you have 314,000. Now subtract 314,000 from our gross profit above. Our gross profit is 548,000. When you subtract that from it, then you have 234,000. That is our net profit. That is the profit statement under absorption costing. Please keep up with the videos, lectures that will be dropping to this YouTube channel from time to time. Subscribe to keep up with the videos. Thanks.